many people want to understand just the overall venture capital market? Put up your hand. Okay. How many people want to understand how VCs look at product market fit? Okay, you guys, are you scared about product market fit? Okay, well I'm going to try to get both, and I have a habit of talking fast. So what I ask is, let's make this interactive. If I say something and you have a question, just put up your hand and I'll glad to get off the subject. So maybe I'll start with saying this, just a bit more my background and why, is this better? Do I have to eat this? Okay. Why I'm here speaking today. Being in Tech Toronto, that's great. I've been a founder, that's great. But more importantly, I helped launch AngelList in Canada. So I've seen about 500 Canadian deals on the platform. I have a venture fund that's invested in about 80 companies now. And so I've seen this ecosystem and seen what companies get funded here for about a decade now. And what I'll start off by saying, it's never been more confusing as a founder reading BetaKit or TechCrunch to understand what's going on. So I'm going to start with how I view the venture capital market. Again, this is one person's perspective. I find I'm also view the world a bit more American than lots of the people in this ecosystem, because I spent a lot of time in the States building my career. But there's basically two things warping everything you read. One is the venture capital ecosystem now is two types of investors. There's funds like mine, which are $30 million, and most of the Canadian market, Golden Ventures, Panache, all the funds here are relatively small. Then you've got the ones that your parents probably have heard of, Kleiner Perkins, A16Z, Sequoia, all the ones that get all the press. They are a different venture fund. So what you're hearing right now is those guys all have billions of dollars in their funds, and they're playing a very different game than the one that's relevant to you. What they're looking for is to invest $50 to $100 to $200 million in winners. So when you hear about Cohere raising this massive round, and you hear they have very, very little revenue, or you hear about OpenAI now has revenue, but like these guys are looking for early stage companies who can need a lot of capital, can scale very big, and have an established team. And those companies can raise 20 million with just an idea or 50 million with an idea. And they then can get 100 million just because they made some progress over the last 3 months. And that's what's dominating the Globe and Mail, that's what's dominating most news. And that's a fairly recent phenomenon that confuses a lot of founders. Because most of you, I assume no one here is building a foundational model or a new chip. Am I correct? No hands going up? So what you read in the news, that confuses a lot of people because you're seeing these rounds, seed round of $50 million, or this founder, they're walking away from OpenAI and raising $100 million. That's not the game most of venture is playing. Most funds are names you've never heard of, and they're focused on a specific thesis. It could be geography, it could be type of founder, it could be a sector, and they're focusing on a segment of the sector. So, and I'd break it up into three. I call it early stage, because again, names mean nothing. So that's the pre-seed to seed. That's your first check and maybe your second check. I call traditional venture, which is what you hear as the A and B rounds. Those are $5 to $20 million checks. And you have growth, which basically are helping companies prevent from going public. So when you look at this industry, you now have a bunch of these huge mammoth funds playing their own game, and you have all the other venture funds which are focusing their own specific sector. So where you are right now is, I'd say, early stage. And you're gonna have to probably raise a couple times when you get to this mythical product market fit. And when you're looking for funds, so now I'll try to talk about how venture funds look at your company and what you have to sort of validate to earn a right to raise money. I think the first money that comes in is pre-seed. That's pre-product market fit. And what a venture fund is looking at is, why is this a team I want to back and an opportunity I want to back? And so the way you can validate that is, to a certain extent, you have a natural advantage. Whatever you've accomplished before, it could be, so you want to show the personality of your founders. Why do these founders fit together? Why, someone's coding and someone's selling. Someone has industry expertise, someone can build it. So why is this the right team? And then you want to show, hey, even if you don't have lots of experience, you want to show your team to bet on. Everyone's looking for something different, but if you can show you can learn quick, you're tenacious. So when you go to pitch, it may not seem relevant, but I don't know, you're captain of your varsity track team. That's super valuable because they say, okay, this person was able to train every day. She wanted to compete. Same thing if you were a pianist, or if you're a math Olympian or whatever. So anything that, or anything you've accomplished before you start a startup that shows you have the ability to basically grind it out, learn, and try to be world-class and competitive helps. The second thing is, how does this team complement each other? And third is, why is this team the right one for this opportunity? In a weird way, everyone wants to back the same idea, but also wants to back something they've never seen. Because like I can tell you, if you come to me with an agentic AI opportunity, I've been pitched it probably 20 times this month. Like I'm not joking, it's like crazy right now. Every day, 2 agentic AIs, I'm gonna automate bookkeeping, I'm gonna automate, I don't know, whatever. But so if you're gonna pitch something like that, you have to have you have to know what's going on in that space and why you have a different opinion and why it's important. Hey, we're gonna go after these customers first, we're gonna train the model and it's gonna give us a long-term competitive advantage. Or if it's a space that no one's pitching, you have the problem is people are gonna say, why should I care about this market? So you should say, here's the opportunity, here's why now, and here's why this can be big. So basically what you're selling when the first time you go to raise is you're selling a story. And what's interesting is you'll probably look to raise $500,000 to $2 million, so you have to explain what you're gonna do with the money. But what we're looking for is you're gonna be able to hopefully get to that product market fit or close to with the money you're getting. So we're gonna be judging your team, the opportunity, the insight, and your personality to say, can this team learn fast enough, move fast enough to get the product market fit? Because it's hard. And it's really hard because there's a lot of small funds, and 99.9% of them you meet will tell you to get lost. And they'll give you some bullshit excuse why they're passing on you. First thing is, what you can do to get your story right, and then you have to figure out who's interested in your space or your team, right? So like, I've invested in consumer, but I really don't like consumer because I don't think Canada's a good position to launch. I focus on Canadian companies. So like if you're pitching me consumer tech, Canada historically has not done well there. So your bar for getting past my screen is probably higher there than if you're enterprise SaaS, just because it is. And if you know that, you probably want to pitch me first so I give you a bunch of feedback, you get practice, and then you go to someone that focuses on consumer so you've already heard all the reasons no. Because the worst thing you can do in a deck, let me take a step back. Founders are very scared to say what they don't know or what the risks with their business are. I find if you can go in your deck and say, here's the problems with our business, and here's how we're going to address them, it's very good. Because what happens if I'm not an expert in your space, and in your deck I start thinking about all the problems with your pitch, I'm like, okay, it's been 30 minutes, I can find these problems they're ignoring. So to be upfront and show you know your space and be confident you can do it, no one does it. 1 out of 200 founders do it. You already have a lot more credibility. So I'm talking fast, I'm covering lots of areas. Is this all clear?
As you said, we've met so many founders and they're asking the same domain they're talking about, some element of AI. We know that's going to change the world in the next few. It's going to be a tsunami of how do you decipher this is going to be a good startup or that's going to be a bad startup, or how do you make sure that it doesn't look like a herd coming and trying to do the same thing? Because funding is limited.
Let's go to financial AI agents. Okay. I'm going to automate bookkeeping. I've seen 5 myself in Canada. Okay. I know if I read, Sequoia probably is a bet for $20 and someone else. So like, fundamentally, I start with the founders, but in this area, I have a huge problem with it because there's 100 teams going after it. It's an obvious idea. There's a bunch of well-financed teams with big names already taken off the table. If Sequoia's put $20 million in the company, they're not going to invest in anyone else if they go bankrupt. So I need to see something. Like the bar for me investing in that space is so high, you have to blow me away, right? Like, because it's too obvious of the space. So either you have something unique, you have a unique competitive advantage. It just, one, I think is messy. Like, by the time I'm getting so many like that, it's just hard to have the neuroplasticity to invest in the space. And again, there's others that are just not as hot, but I keep on seeing like splitting banking accounts for the couple. I get this pitch every 2-3 months. Lots of them being financed. There's actually one just financed by Golden and I think A16Z, and one of them will work one day. But unless you're a founder that's researched all the rest and said, hey, here's the 20 other companies that have tried this over the last decade, here's what they've done wrong, and here's why the timing's right, and here's what we're going to do right, you're starting at -10 when you pitch me, right? So if it's something that's been around a lot of time, like, I keep getting pitched, Uber competitors, we're going to do less fees. Okay, great. Okay, yeah, of course you're going to do less fees, but then how do you build a company that works? So like, I think if something's really hot or something's been tried many times, you need to know your space. Really, you have to be a great team, but you have another hurdle where you have to say, hey, here's what we've learned about everyone else, and here's what everyone misses out, and here's why the timing's right. And then, I think those are what the hot areas. But because if you look at what I've got 2 legal tech that are huge home runs for me, One I invested in 5 years ago, another 3 years ago when no one wanted to touch legal tech. And I tried to get anyone else in Canada to invest in these companies, no one did.
Is Clio one of them?
No, Clio, actually the founders of Clio are both LPs of mine.
Okay.
They're a bit, I wasn't investing in that, but like one's a company called Even Up. Has anyone heard of Even Up here? Canadian company, a unicorn, doing about 100 million 5 years in. No one want to touch them. Now, for whatever reason, founders do research. I'm a generalist, but they see, I'm an Even Up in another company called Spellbook. I get every legal tech company now in North America. And you know what my thinking is? I saw one a year before, and I see one a day. It's hard. It's an obvious area. And that's my preference. There's going to be people like, I don't know, Garage. If you get through YC, Garage, I think will be even more founder-centric and will take an investment in a crowded space, but they'll probably look at what's your background, how can we sell you, how can we package you up for your next round.
So my takeaway as a founder would be, if you're an investor, make sure if I bring my competition analysis very well laid, even if it's a crowded space, I know what they have done, where they are wrong, how I can improve, that at least I can have a sincere dialogue with the VC.
I invested in a couple company areas I absolutely hate in the last couple of years. One I was doing, it started off as an advertising platform for short form video. I'm like, okay, I hate advertising platform. I hate someone taking care of influencers. But this team had come from an ad tech company. They explained the why now, they explained their unique insights, they explained everything that went wrong. And I'm like, okay, and just seemed like a team that just, go do everything. Now, they've gone really deep into a specific area. They're actually now just supporting musicians.
Okay.
But they got me to invest, and I can say their why now is right, and they're going to be probably one of these companies that either doesn't raise and just becomes like another Stack Adapt, who just was covered by Globe Mail today, or it'll be very hot because their numbers, they're going like this because they were right and their insights were right. And my barrier for I keep keeping it ad tech and the creator economy. Both those are okay, I don't want to talk. I almost didn't want to take it, but they can't. They just look like an interesting team. Any other questions? I think the why now is also under.
There is very less open source things which happens in this ecosystem, right? So what's your advice on somebody building a segment-centric company which can be...
Who are your customers? Who are your customers?
Customers are, let's say, construction companies.
I don't care you're open source. I think as long as your customers are here, that and you can explain why here. Because I think DevOps, if you're doing DevOps or dev tools, Canada's a very hard place to build again. So we've actually had founders that we've invested in go dev tools or go to the States. So I think also another thing when you're pitching some company, something that gets hidden is the why now doesn't get talked enough about, and also why you're based here, right? Because I think sometimes you're at a geographic disadvantage, right? If you're selling to devs, we have a lot of devs here, we have a lot in Vancouver, a lot in Montreal, but you're better off being in Austin or San Francisco, where there's been historically dev companies and there's a lot of people willing to experiment with. So construction industry, Canada, we seem to make money off real estate, so everyone will buy into it as.
When you have an open source thing where a dev tool is using, then the enterprise customer comes from that only, right? So it's exactly the same, right? What's your advice on somebody taking the entire approach and putting in something like construction, which is the thing in Canada, right? So doing something open source so that they're using it, and then the marketing funnel comes.
Well, again, I think it's a very specific question, and I'm happy to spend more time with you, but I think there's no reason that someone shouldn't like it if it makes sense.
You said something about putting your problems in the slide deck.
Yeah. How are you, hey, you're going freemium right now, or I'm trying to think of one right now, but I'm listening to someone and go, there's regulatory issues, right? So you can say, hey, there's a regulatory challenge here. Here's how we're going to address it or not address it over the next 18 months. And maybe it's not you put in the slide, the deck you send around to VCs, but you have it in the background in the appendix. Here's the 5 biggest problems. Here's the 2 we're going to take care of over the next little while, and the 3 we're going to ignore, and here's why they're not really problems. Or we're aware of these problems, and here's how we're going to tackle them or mitigate them, is extremely strong. And I'm just, it's late at night, I can't think of any, but when I'm preparing a founder for the next follow-on raise, we go through all the problems and all the objections you're going to get, because you know what keeps you up at night about the company not working, and some of them are relatively obvious, or just someone with some logic can figure out. So if you can address them heads on, because otherwise, even if you do a good impression, the person goes back, they start making their memo, and they have all these questions, and don't even want to bother. But if you can say, they told me about this problem, they're going to take care of it. I don't know, you're competing with Airbnb. Airbnb is going to copy us. Well, anything you put in your deck and you say when you meet me at the stage, I think what I'm trying to see is see how you think and how knowledgeable you are and how you learn. And so that competition slide, everyone just puts some stupid slide, 2 by 2, we're fastest and we're biggest or whatever, and we're here, and then, oh yeah, Google sucks. But you know what's much more insightful is saying, hey, Google's going to own a big chunk of the market, but we're going after, we're competing on, we're not, you know, like look at what DuckDuckGo must have done at the beginning. We're not going to take any data from you, and we're going to do the generic advertising. So Google can't compete because that's screwed their model, and they have to shrink a lot of revenue. Or even what Perplexity said originally, we're not going to do any advertising, and we're not going to have all the links. So fundamentally, you can say now Google, if they see what we're doing, they can't compete with us because the revenue's going to shrink. And you can say at the beginning, this is the market of the 20, you know, the 10% of the market wants this because it's a better product. That's how you do it. That's how you do a competitor slide. Like, and then that's what I'm also looking. So like that way, let's say one of the things is like, hey, you're competing with Airbnb, and you know, VCs. Oh, what if Airbnb copies? You can say either you have a competition slide that addresses that up front, or you can say, hey, we know Airbnb can compete with us, but we believe in the next 3-4 years we'll be building network effects before they realize this is a real opportunity for them. So like whatever the obvious questions are, risks with your business, try to address them. And it doesn't have to be in your main deck, but you should have a page you can pull up and just talk to it if the conversation's going well. So, yeah, okay.
If you can convince big money to put big money in, all they said was, we're going to take this dinky little software all over the world. We're going to get millions of people that are going to use this. Right? So if you can, the accounting example that you gave, if somebody says, I can get every small business across the world to use this, and I have a compelling argument, and I close the deal with some VC, some big VC that puts in the money, then you hold it, and then you execute. Right? But it's that thing. Who's going to make that thing? How do you? So it's a whole bunch of different things that have to come together.
So if I was pitching Shopify, again, it's easy in retrospect, but you can go, we're going to have a high churn rate for the next 24 months because we're targeting SMBs. That's okay, because when you get companies early, half of them are going to, like if you're targeting restaurants, a third of them die every year. But the ones that grow on us will grow on us and will have great net revenue retention. That's a perfect example of something you can address. Because any VC that's seen a small business hates small business because the churn's high. So you can say, yeah, we know churn's going to be high, but we're actually trying to capture customers before anyone else does. So it's not a number churn we're about revenue retention growing with our customers. And that's what Shopify historically did really well at the early days. They got a bunch of companies that were nothing, and then all of a sudden they had Allbirds doing $1 billion revenue on them. And they had Figs, which went public, right? So like, but they always had high churn rates. So like that's a perfect example of something in that risk page. So
I guess just to stick to this, what are some of the other slides that you like to see here? And it's all
okay. If you're sticking to your slides, you're not getting an investment usually, is my belief, right? Because you're selling a story at this first time you go raise, it's a story. So I think in your deck, the first thing should be is why is this team kick ass? And so what everyone does wrong is they put a bunch of logos under their face. But what you should have is you should have those logos, but you should have one thing that brings out something they wouldn't know about you. Again, I won an ultra marathon, or at my company, you know, I served SMB sector of Shopify, right? Like, bring out something that shows that you're kick-ass and or is relevant to what you're building. I think the next thing is show from bottoms up how big this market is. What sort of it's like the team, the problem you're solving, who you're solving it for, and why it matters for them, how big the market can be, and what you're going to do over the next 18 months are the ones you have to have. Everything else is nice to have. The competition's nice to have. Anything that you can show that what you're trying to show is that you notice opportunity inside out, right? Or you think you do. Because like anything, like I also like if someone has a financial model, I'll look at it. I think all the numbers in there are bullshit. But what I'm looking at is thinking about how's this person thinking about growing their business, right? Because lots of times you'll see weird things and then you have a conversation like, is this implicitly, is it number of salespeople? Is it number of calls I make? How much revenue? Like, there's a bunch of assumptions there which are more important than any number because you're never going to hit any of those numbers, right? But I want to see the logic in how well you know your business, right? Because like, again, like what lots of VCs have is they just know there's business models that don't work, right? If you're selling to enterprise and your average sales value is $5,000 a year and you have salespeople, the numbers don't work. And that's fine. But if you can explain, hey, we're going to do this and eventually we're going to get to 25,000, but we're just trying to get early customers and get design partners. But like the key slides are team, business problem, who has this, sorry, I'm not going to be consistent here. How do they try to solve this better before and why we can solve it differently, and then why now and market size and what you're doing. That's probably 8 to 10 slides. That's good.
You said 18 months, and I've heard a lot of people say, oh, you need to have your 5 years plan all the time.
What you want to show is that this is a big opportunity. Yeah. You want to show you're raising enough money to change the company. And then, some people ask, for projections, year 1, year 2, what they're trying to see is how aggressive you are and that you believe this can be big. Like a complete turnoff is, I see we're going to be $500,000 this year, $1 million next year, $2 million the year after that, year 5, you're $5 million. I'm like, okay, they're not aligned. Like, I think in Canada, we don't know what big is, right? Like, I talk to a lot of founders, we're getting to 1 million revenue, oh great. And then we're going to be at 10, and we're going to be awesome. I'm like, no, your American counterparts are talking about how to get to 100 in year 4 and 500 in year 6 and $1 billion in year 8. But they're showing they're ambitious. So if you're if someone's asking for something more than 2 years of like, what are you doing with the money you're raising now? Like, you should be showing why it's a big opportunity. But if you have to do that, say, here's how we get to like 10 million in year 3 and 50 million in year 4 or whatever it is, right? So, I think what you should be raising for is enough. Okay, again, let's talk about the other thing which we didn't discuss is how much should you raise in this first round? Canada, we have a lot of people go say 750 or $1 million or make up some number. The number should be actually rational. And what I mean by that is you should say, okay, we're going to change the business like this before we go raise next. It's going to take us X number of employees, Y number of overhead or marketing, and this will let us accomplish that. It can be true with consumer or something viral, but it's very hard for lots of when you're selling to enterprise because it's not like enterprises wake up every morning or medium-sized businesses wake up every morning looking for solutions. Sometimes they have to know they've just given up. So you have to be able to prove that you can solve it. But like I'll give you an example of a company right now. They're adding about 50 to 100,000 ARR every month. But more importantly, I just did some calls because I was going to put more money in them. And okay, I'm sure he gave me his best customers or ones that are most likely to talk about it. But I did 5 calls. 4 of the 5 said whenever they talk to anyone else in the industry, they said you have to use this product. 2 of them said if they take the software away, they'll lose all their employees. And one said particularly employees hate any new technology. They fought me for 3 months. Now they say it saves them like 30% of the day. So like the customers love it, and they said, and if the company, one said, hey, we're looking for these to replace 2 software. If the company wants to offer that, we'll just take it from them because we believe anything they build is best in class. So that's a qualitative thing. I think that's even more important than just seeing the volume because you could be selling $5 for $2 and then you'll have too much demand. But when customers are building word of mouth and are telling you if you pull this, I'm going to lose employees because I lose this, that's product market fit. Now what's interesting is product market, I think the easiest way to find product market fit is so counterintuitive to everything VCs will tell you because everyone says you go for big market. The way my founders usually find it is they go to a very, very focused market. They limit the market size. So they start off saying we're going to serve all service businesses. Then they go, okay, we're going to serve only management consultants. Then what they find is, well, the McKinsey's, BCG worlds, they're just too long. So we're going to sell management consultants selling projects of 6 weeks with companies of 5 people. And then they can build that because the word of mouth gets there. And then they can go and then you can expand from there. So it's counterintuitive. You're better off having a smaller market where you can show that there's a lot of demand and product market fit, and then showing how you can go to adjacent markets or get more money from your customers. But it's part of what you do is after you raise is you probably have a thesis, and then you almost what I'm like, and I think it's very hard to get product market fit in 18 months. I think very few companies do it. So what I'm looking more if I'm doing a follow-on is how fast has that company learned? What have they validated? How fast? Basically, how fast can they execute and learn? And so part of that is starting with your thesis after you raise the first one to really focus on that area where you can get heat, where you can get product market fit and get closest to showing it. Because I'll just go through my companies I've invested in the last 18 months, so all at the pre-seed level. I break into 4, when I just did analysis at the end of the year, I broke into 4. So ones that have signs of product market fit. That's about 15 to 20% of them. So, and again, it's a small amount that I find that incredibly great. There's some others that are investing in infrastructure because sometimes you can't show product market fit in the first 18 months. So I have a company that's building for enterprise retailers. The team's really credible. One was the head of Loblaws Digital, and then Marks and Spencer Digital, and then the other was the CTO at Loblaws Digital. But they've got 2 customers they're building it with. It's going to take them 18 to 24 months to get the first product out because these customers all have $1 billion revenue. They're going to put $1 billion revenue. They're using it for their supply chain, so it has to be pretty robust. So my view when I'm checking in with them Is are they making the right progress? Are your customers working with you? Do you have is there a conversation? Are you getting feedback and what are you learning from? And do you have a clear idea where it's going to work for both customers? So you're not building two custom pieces of software, but when we go raise, we can show we have two customers that are deploying it, that are paying us for it, and then we can repeat it with multiple. Because these 18 months, you're not going to show you have 20 enterprises. And the other ones that I'm happy with are ones that are doing lots of customer development. They're like, okay, it's not working, but we're talking to customers every day. We're learning, we're refining, we're understanding where we can have it. And then there's other ones which are pursuing something, don't seem to be learning, and don't seem to have product market fit. So I can tell you right now, the ones that raise easiest are the ones that have product market fit. And the other ones in other categories that they position what they've done over the last 18 months will have a good chance of raising. They may not raise, but they will. The ones, I've actually one at 3 million revenue, I think is not going to be able to raise because it seems to be all over the place. They can't tell you how to get customers. The customers don't seem to love them. They just seem to be in an area where people are so desperate for a solution to solve it. So they'll go to market, and I think they're the ones probably the highest revenue in the last 12 months, but they can't rate. You go talk to them, and it's not clear they know why they got 3 million revenue. So I think product market fit's the gold standard, what you want to accomplish after the first 18 months after you raise. But otherwise, you want to be able to show that you really have an understanding of your customers and what you're doing. So this is pretty high level, okay?
And I actually got the pleasure of meeting the Airbnb founder.
Yeah.
And they had a poster at YC that said, why commentators told Airbnb that it was a very bad idea. He had a poster of it posted up. And my main question to him was that, like you said, a lot of the numbers are bullshit. There's a lot of businesses that you don't know where it's going to be in 2 years, 3 years, let alone 4 years, if you even exist. And one of the biggest questions I had for a lot of the founders, and as a founder myself, going into pre-seed was, why would Canadian businesses who has their market in North America look for Canadian VCs when from what I have seen, it might be easier to go to America as they're more willing to invest, they're more risk diverse, and being around that Y Combinator's area, they're more willing to throw money around than in Canada. So
every VC has their own agenda of what success looks like. And you need to understand when you go to meet them what their incentives are. So let's go back to a partner at Excel. So I know quite a few of them. Excel has, I think, $7 billion of assets under management right now. All they worried about is which companies that will get that individual partner $100 million in markups so they get full economics in the future fund, right? And then the fund needs to be able to put $100 million into you, and you have to then return 30 times that to make a dent. Because if there's $7 billion under asset management, they put $1 million into you, and you get 50 times exit for them. $50 million on $7 billion doesn't make a difference. So they want to get companies that need a lot of cash and that can have huge outcomes, and particularly partner wants to see that in his or hers because then she gets promoted or he gets promoted. Versus an early stage fund that's like mine. I'm 30 million. I tell the founders I want you to be capital efficient because every time you get diluted, I get diluted. And I don't have to put 5-10 million into you. If I put $1 million in exposure and you get me a 50x, you've made my fund, right? So I've got different alignment than Excel. Now, don't get me wrong. I'll introduce you to Excel if we think we can take the capital and like Even Up has now raised from Bain, Signal Fire, I think Bessemer, and they just raised $150 million, right? So I'm happy with that outcome too. But you have to know the game, and I think YC also has a game. Just going back to them, they take 300 to 400 companies. They're getting a pretty good ownership of you. They want to create the buzz about, anytime 5 to 10 of those companies graduating will raise a ridiculous amount, like $30-40 million valuation right off the bat after 6 months. A bunch will raise at 25. I know a bunch struggle not to raise just because the terms coming out of there aren't, but that's not YC's problem, that's the founder's problem. So go back to the question you said, I think if you want to raise, there is a bunch of programs in the Valley that will look at founders regardless of where they are. YC, Alchemic, there's probably 15 others I'm not thinking of, like Techstars to a certain extent. But I think it's a big myth that you can just walk off the plane and walk around the Valley and raise. Because what you don't hear is lots of these funds that are $30-50 million funds, they're either investing in alumni of a certain world. Like I noticed one called Goldcrest. You never heard, best returns. They have a very simple thing. They know the founders of all the PayPal mafia, and they will only invest in a company that comes recommended from one of the PayPal mafia. And so they got on Palantir early. They got on a bunch of these great companies early. And you can pitch them. You could be, they just won't talk to you. And I think lots of what you hear is initial seed rounds. Like what's true is there's a lot more angels because there's a lot of people that made money. So I worked at, I meet someone, she worked at Pinterest. the first four came from funds, but all four of those funds had someone that worked at Pinterest that knew her, and the angels all came from Pinterest. So like, just walking cold off, like without, the Valley is all about connectivity. And I think if you have the right connectivity, or like, look, if you're Waterloo grad, worked at Shopify, you'll probably find money. But they won't, like, they're quickly pattern match, and there's a lot more money there, and there's a lot more companies there. I think, and also terms will be much more generous there, generally, right? So
another question,
yeah. So like, I don't know if I answer your question. Like, I'd say raise wherever you can, but more importantly, make sure you raise from people you want to be with, and they have the same incentives as you. Right. I think if you get an A or B round, you can stay here, but it's the early stages now, and like even you see that. Like if you ask, I worked with Naval at AngelList, who's probably one of the biggest angel investors of all time. And what he now says is, I used to take people from outside the Valley, but he goes, right now I'd rather get someone like me in Toronto. He's going to look at a Canadian investor founder. He goes, I would rather come through Alex, who knows the Canadian ecosystem, and just pay him a carry than doing a deal myself, because the prominent people there have so much deal flow. Like, the way to do it is, the other way to do it if you don't want to do YC is literally go spend a year there and work in the ways and like play like founder poker and stuff like that, because then you'll get to these tables where these people have made, the crazy thing is, I met a lot more founders in the Valley that made money from angel investing than from their own companies. And they've like, from a founder that had a $500 million exit, they said that they made less than $5 million because there's so much preference stack, but they were an angel investor. I think it was in Uber, which he made like 50 million off of, right? So there's if you want to go spend like a year going to games, being social and stuff like that, and get friends, then you'll be able to get money. So like, yeah, I think it's all about the network there and being part of the in crowd, for lack of a better word. But you had a follow-up question?
Yeah, so I was the follow-up to that was, should founders in Canada spend more time looking for investors within Canada, or should they diversify and like you said, spend time there, network there, and actually do that? Like, what would be more?
I think it depends what we're building. It's pretty consistent what people are looking for, and it's just, do they believe that your team can execute it to a 5x and it's a massive market? How big can this get? Early stage, it's almost, you're better off researching what you're selling and who you're selling to, because there's people that are team first, there's people that are market first, there's people that are why now, there's people that will take cold pitches, there's people that will only go to their network, right? So I think it depends also, like if again, like I'll just pick on dev tools. I think you're better off in the Valley, because I think the investors not only are more open to it, but we actually to hypothetically add value, right? Like, I don't think there's a great, maybe here Chris Newman, I don't know what he's going to do now that he's left Panache. He built a dev tool company, so I'd be pitching him if you're doing a dev tool. And I'm just picking that. Like, but if you're doing construction or prop tech, interestingly, there's a bunch of prop tech funds in the States, but they've all gone, they really prefer A and B rounds, and there's a lot of early stage prop tech across Canada, because there's a lot of families that have made money and they felt comfortable putting money. Like I can't remember, but there's one in Alberta, but like even like White Star, who's not a prop tech fund, their money all comes from like Calac Fairview and a bunch of other people. So prop tech, you're gonna have a lot more credible investors here. So I think where you should spend your time depends on what you're trying to what you're trying to maximize for and what you're trying to raise for. So it needs a bit of research, and it's different for every company.
There's that, which market would really appreciate or understand the problem statement that you're trying to solve is extremely important. If the problem statement is something which is very local to Canada, like I said, let's say construction in Canada, believe me, there could be VC which invest in prop tech. They would say, I have enough in US, I'm not in Canada, or they don't understand that market. So that's also extremely important. So who would really understand and appreciate that problem?
If you look at the big winners in that space, actually less than 50% come from the Valley. So I think there's a lot more investors outside the Valley that will look at that, will feel comfortable. Like if you're doing a consumer tech, you're probably best going to the Valley or LA, just because they have a lot more hits there. And I think just the social influence of those investors play a lot more to help the consumer tech. But like, life sciences, you also should be spending time in Boston as well. So you had a question?
Yeah, it's a question. Following up on what you're asking. So if a company had a deep tech infrastructure play, is it better to raise money in Canada or the US, or how would you go about that in this ecosystem?
How much money do you need, and what's the deep tech? Because like quantum, there's the deep tech it really depends on what you're doing. Like if you're doing defense tech, there's one fund in Ottawa that can do it because so there's actual some stuff that structurally you can't raise it for Canada generally. It's anything called the sin industries are prohibited. Like lots of funds in Canada have money indirectly or directly from the federal government or provincial government, so they probably can't invest in alcohol, pornography, gambling. Most can't, interestingly, invest in defense or weapons. So I just had a defense company, someone's doing a smart gun pitch me. I can actually invest in that. I went back to looked at who my LPs are. I'm like, okay, are they getting upset with this? So I think there's certain parts of let's call it deep tech, which just structurally, for various reasons, are hard to raise in Canada. But Canada actually especially in life science, has a lot of deep tech investors. Then I think if you're talking about quantum or aerospace, there's just a few funds across North America, and you should do your research and find them out. There's a couple of big ones in the valley, DCVC and Lux, but there's for each deep tech space, if it's agriculture, there's a couple of good funds in Alberta, right? So it really depends on what you're doing. And the good thing about deep tech is there's not a lot of investors, which means it's easy to find them. I'll say robotics, you probably want to go to States because again, I've done a couple of robotics investors. I know there's no one else here that wants to invest in robotics. So I've actually, what I've done is I structurally know who my co-investors are in the States. I can bring my robotics companies there. But I think the more, if it is deep tech, you can go find, there's probably 20 funds that are early stage North America wide, and you go hit them all.
BJ briefly mentioned before how initially when a company gets a few VC on board and when they pitch, they have more successes moving forward, and that kind of accelerates their growth and everything. But I think it's always the most difficult part is getting that first investor, getting that first job. And what happened with Dropbox, if you guys know the software, is that they initially were lucky to find an early adopter investor that were willing to invest in them over other more established competitors that were doing the same thing, because the early adopter investor just likes to see new change, and that was his characteristics. So actually, my question too is just, Alex, are you an early adopter investor? Would you say so?
A founder came to pitch me on something for targeting realtors. My wife's a realtor. I've been helping her try to build her tech stack, and I go, okay, if this works, this solves all her problems. I said, and I knew this guy too because I met him 3 years before, and I said, if this works, I'm willing to give you a check right now. I think hopefully every venture investor is an early adopter, but there's also, I'd say the correlation doesn't always there. I'm an early adopter and the quantified self. I hate this space because I've got a Whoop here and I've tried a bunch of other stuff, but I think I'm not a good investor for that space because I think it's capital intensive and I don't like doing stuff that are capital intensive. So I think what the best way to find if someone's an early adopter, and I don't think many funds do this in Canada, but there's a bunch, is to go look at someone's Twitter or X or whatever it's called, or LinkedIn post, go see what the blog post, because a lot of people will talk about what they're interested in. If you know they're interested in something, they'll at least want to talk to you about it. Doesn't mean they'll necessarily invest in it. I've been pitched longevity is another trend. It seems like every male over 40 years old wants to live till they're 120. Doesn't seem to be females. I don't know why. I guess because you guys already live longer than us. But I've been pitched it many times, and I want to invest in it, but no one's actually come. The problem is, no one's come. It's a space that I want to invest in, but everything seems to me too and doesn't have a great business model, right? So just because I'm an early adopter, something doesn't mean, might be bad because I might have done a lot of research in areas. So but I think it's very simple. If you do your research, a lot of the VCs write a lot somewhere, either on their blog posts, either on LinkedIn or Twitter, or you can even see what their investments in the past are, right? Because everyone has a predisposition, right? I also because I think one of the hardest things is any investors have neuroplasticity to change what you look at, and there's certain sectors I just have an allergic reaction to, and I know I'm going to miss something, and I'm trying to be neuroplasticity. I actually have a partner, and I said, you guys, you have to look at all the deals in this area because I'm automatically predisposed to say no. So I think it's just do your research, right? I'm so what is it that you're trying to be looking for an early investor?
You already mentioned that you don't like capital intensive.
Well, look, and you know why I don't like capital intensive? Because I only have $30 million in my fund. So I don't have the ability to put $4 or $5 million into you. So there's two things, and I think go back to deep tech. I think the other problem is there's deep tech pre-validation of the technology, and then there's commercialization. So I have investment in a company called Synex, which is as deep tech as you can get. Founder came to me and said, I'm going to shrink MRIs down so I can do constant glucose monitoring off a ring. So we invest in that. It's taken him 4 years to validate the technology. So now he has to start commercializing it. So like this, he's been actually relatively capital efficient, but like I think the problem with capital expenditures, when you're a $30 million fund, like even if you win, and I'm right, there's odds are there's going to be a shitty round in there that I have to do what's called a pay to play, and I have to invest. And if I don't have money, I'll get wiped out. So I could be picked the right one. I could return a lot of money for people. So like structurally, I know my weakness with capital intensive businesses is that I can't play with the big boys, like for lack of a better term, right? So, you want to probably go to bigger funds because a lot smaller funds or funds that can there's again, if you're in the clean tech, there's like I think it's Arctex, I can never remember the fund, Arcturn, right? They're not a huge fund, but they know how to get a lot of non-dilutive capital for you, right? So like that could be a win, right? So again, everyone has, the best VCs know where to compete well. I think lots of them don't have a clue and they'll just invest in random stuff. But that's what you want. You want a partner that knows what he or she's doing.
The founders in San Francisco invested in other companies and made more money than their own exits. So I also always tell founders, have an ESOP. That's very important for your ecosystem of next generation. So the employees are encouraged to get their share diluted from invest in other startups. So
you're 100% right. I think people say, every once in a while government goes, what can we do to make this country better for startups? They'll just have more exits. But also if you're looking for angels, look at who just raised a big round and probably had a secondary. For a while in Vancouver, every employee from Boots was writing checks like the government sailor, right? It's not happening anymore because they never got public, but Wealthsimple employees all got big secondaries on the way up. Shopify, now that stock's back up, are probably there. And StackAdapt, I'm sure that was they said it was a secondary, $300 million. So I'm sure there's a bunch of employees or founders there you hit up. That's the other thing. If you want some, and usually people have made, everyone invests in real estate in Canada because everyone made money in real estate. That's why everyone talks about now, but so if an employee made money as a startup, they're probably going to be an angel investor. So I'm just thinking Toronto right now, StackAdapt just had a big secondary, Clio had a secondary, and they have a bunch of people in Toronto. They'll probably all love me for saying this. But that's what I look, because Canadians, that's the thing, the value, to hit people up, and everyone here, if you look at who's had secondaries, and if it's not Shopify and Wealthsimple, there's probably no one setting them up other than their friends. And I'm not saying it in a bad way, but these people want to get back to the ecosystem. And we do have a thriving culture here of angels. They're not like the Valley, they just don't want to be known. The team from Wave has been active, right? Because they exited HR Block a few years ago. And it's probably good to just hit them up after they just had a secondary, because what happens is first time angels write too many checks too quickly, don't realize it takes 10 years to get the money back. So after 3 years, they have no money to invest. But and as the OSC probably doesn't want to hear this, go see who's had a go see, if you read the big funding announcements, not to know, don't look at it as an opportunity to find some potential angels, right? Because we don't have as many successes in the States, but there's been a lot of secondary. Imagine, in Montreal, I'd be talking to Hopper employees, right? So that's one way to find angels too. And angels want to get back to community.
Right.
Yeah.
That was the second question.
That's okay, fine with me.
How do you cold call someone you've never met before?
Well, look, the best way to any investor is get a warm introduction from someone that actually knows you. So it's actually worse to get someone to just give you, I've had founders just get a random founder in my portfolio to reach out to me. I'm like, what do you think of the person? They just asked me the first email. Well, okay, so it's actually less, it seems a bit shady. I just wrote a check, I'll be writing a check tomorrow to a company that cold emailed me. I think they may fill out the application on my website. So I think if you want to cold email, you can see in the application, I have a form on my website, and I've now narrowed down to questions. I'm can't remember what I asked, but it's what's the unique insight? Why is it big markets? Because this stuff you can send me the deck, but I think it's understanding, making something custom enough to make the investor feel like it's not just a cold email, right? It's personalized. Because I get emails, I'm okay, they sent this out, they went to Crunchbase, took all the investors and just found everyone doing SaaS and emailed them, right? I explicitly say everywhere, I invest in Canadian founders or Canadian startups. I get stuff from the States, I'm not going to respond to you. So I think first qualify the person you're emailing, and then if you can get a warm introduction, great. If not, do something pithy, telling them why you're interesting for what they do. So hey, I saw you invest in your deep tech. Let's say your quantum. Oh, I see you've invested in quantum companies before. You have no company that's doing fintech quantum. You've talked about it. Here's what I'm doing, and here's why I think it's interesting. Here's why we're awesome. Like 3 lines, and then and expect you get a low response rate. But if you spend it, you're better off spending time. And if you don't write well, you can always put it through one of the LLMs. But then it seems kind of generic. But like, that's the way. Spend the time there, just like you would do with a sales prospect. Did I think I've covered part of market fit. I got you to the seed round. A round and B rounds are different discussions. Anything else?
TiEQuest, at the end of this, there's also a trip to Silicon Valley. So there's TiEQuest. So you got a best of both worlds here as well.
So that's a perfect example of cold email someone in the valley. Say, hey, I've chosen to go in TiEQuest. Maybe you don't know what it is. I'm going to be in the valley presenting. And I want to take my time out. I'm going to be here. I want to take an extra time to meet with you because I see what you do. And I go, and then I don't believe in the don't ask for money, because as people say, ask for money, you get advice, and ask for advice, you get money. So I'll get into that. But like, if you have a reason you're going down there, and you can do a smart cold email and ask for 15 minutes, coffee, you're much more likely, because you're not making the trip. You can always bullshit, say I'm going to be there for something else, but like you're actually going there, and you can leverage it, and then they can look it up, and I think you get a lot more credibility. I think the other thing I've seen, just going back to fundraising, sometimes fundraising is a big distraction, but you can build your own heat. Like I just had a founder, he had a company where he knew he had enough results going in, that he had enough sales, and he knew what the next few months would look like. The team was doing well, and he just spent 6 weeks in the valley, meeting everyone, and he created his own heat because like the word gets out, but he did it in the right way. So like I do think if you do concentrated. And it's not for the first round, but for the second round, if you have enough momentum, and you can, there's ways you can build a bit of heat, and that's the other thing. Like every smart VC worries why they get a sealed deal, but they also want to get in the hot deal. So it's like there's ways to socially structure that, and that's a whole other conversation which we can have at another time. But like,
Might have to get you back, Alex.
well, I'll see the founder that did that, and A wants to talk about, because I think. Hearing it from a founder perspective, he can tell you a lot more what he did. Yeah. I also say if you have the right VCs, work with them for the next round once you start showing product market fit. Because I have a lot of founders that just want to take a bunch of shortcuts and listen. Like, if you have a good investor, they'll help you raise that round, right? But like, if you know what, ping me and I'll see if I can get that founder to speak, because he just did a great job.
Akatan has arranged few, but we'll definitely get few founders, because we got the investor perspective. It's always good to hear on the other side. So this is. And
anyone can feel free to reach out to me. I will try to get back to you. It may not be right away, but I will. Yeah. So thank you so much.